10 smart ways rich people invest their money. What if I told you that almost everything you've been taught about getting rich is wrong? That 401k, the slow and steady mutual fund, the whole idea of just saving your way to a comfortable retirement, that's plan A. It's indeed a safe route. But the truly wealthy, they aren't playing the same game. They're not just aiming for the comfortables. They're using a completely different playbook, one designed not just to grow their money, but to seriously multiply it. Forget what you think you know about building wealth, because the rich are following a different set of rules. For most of us, financial advice boils down to saving what you can and putting it in the stock market. And look, that's not bad advice. It's just incomplete and a bit unsafe. It's like bringing a knife to a gunfight. The wealthy get that true financial freedom isn't about your salary. It's about owning assets that work for you around the clock. It's about using debt as a powerful tool and seeing the tax code not as a punishment, but as a roadmap full of incentives. In this video, we're breaking down the 10 smartest ways the rich invest their money. We'll cover everything from practical steps you can explore today to the exclusive tactics the ultra-wealthy use to build their fortunes. And you'll want to stick around for number 9, where I talk about how they legally minimize their taxes. It might just change the way you see your money forever. 1. They master alternative investments. The first big shift is where they put their money. The average investor portfolio is a pretty simple mix of stocks and bonds. But for the rich, that classic 60-40 split is ancient history. In today's economy, the ultra-wealthy allocate a huge slice of their portfolio to what are called alternatives. This means things like private equity, hedge funds, and private credit. A report from Tiger 21, an exclusive club for ultra-high net worth entrepreneurs, showed its members had a staggering 54% of their money in private equity and real estate alone. So how can you do this? While you probably can't buy a multi-million-dollar stake in a startup just yet, the world of alternatives is opening up. You can get exposure through real estate investment trusts or REITs, which are just companies that own income-producing properties. You can also look at crowdfunding platforms that let you invest in real estate or startups with a lot less cash. The main lesson here is to start thinking beyond just stocks. You need assets that zig when the stock market zags. 2. They treat real estate as a business. Next up, real estate. But the wealthy approach it completely differently. For most people, their home is the biggest investment they'll ever make. For the wealthy, their primary residence is just a place to live. Real estate investing for them is an active business, not a passive investment. The accessible version is buying a rental property. It's a proven model. You generate monthly cash flow. The property, hopefully, appreciates over time, and you get some nice tax deductions. But the ultra-wealthy take it to another level. They're buying large-scale commercial properties, such as office buildings, industrial parks, and massive apartment complexes. They syndicate deals, which means they pool their money with other rich investors to buy assets they couldn't get alone. They use borrowed money strategically to control much larger properties. It's a game of huge scale, but the principle is exactly the same. Buy cash-flowing properties that other people pay for. 3. They buy into businesses directly with private equity. Warren Buffett once said his favorite holding period is forever. He was talking about owning great businesses, not just trading stock tickers. The wealthy have this exact same mindset, which is why they're so big on private equity. Private equity is simply owning a piece of a company that isn't on the stock market. This is how the super rich get in on the ground floor of high growth, companies long before the general public even knows they exist. They might invest in a promising tech startup or help buy out an established, family-owned company. It's definitely high risk, high reward, but it offers a kind of massive returns that are almost impossible to find in the public markets. For most of us, this world has been closed off, but those barriers are starting to come down. There are now specialized funds and platforms that let accredited investors get a piece of the action. Even if you're not there yet, the lesson is crucial. The biggest fortunes aren't made by trading stocks. They're made by owning a piece of successful business. For they use hedge funds to win in any market. What if you could make money even when the stock market is crashing? That's the entire point of hedge funds, another favorite tool of the wealthy. Unlike a typical mutual fund that just hopes the market goes up, Hedge funds are built to make money no matter what the market is doing. They use complex strategies like short selling, where they bet a stock will go down, and other tools to manage risk and find opportunities. For the ultra-rich, hedge funds are like a financial Swiss Army knife, a defensive shield for their portfolio that can churn out profits even in a downturn. This is another area that's slowly opening up. While you might not be able to put your money into a traditional hedge fund, there are now ETFs and other funds that try to mimic their strategies. They can give you a taste of going beyond just buying and holding, helping you protect your portfolio when things get rocky. 5. They invest in passion and scarcity with collectibles. From vintage Ferraris and rare whiskeys to fine art, the wealthy have always invested in tangible things they're passionate about. But don't get it twisted. This isn't just a hobby. It's a smart, strategic move into assets that are scarce, hold their value, and don't care what the stock market is doing. For example, contemporary art has appreciated at an average of 11.4% a year since 1995. The ultra-rich have teams of advisors and exclusive access to auctions to snap up these rare items, seeing them as both a store of value and a hedge against inflation. So how can you apply this? You don't need millions. You could start with more accessible collectibles like rare watches, first edition books, or even high-end sneakers. The trick is to focus on items with proven scarcity and real demand. There are even platforms now that let you buy fractional shares in multi-million-dollar paintings. The idea is to own things that can't be easily copied because, in a world of digital everything, real scarcity is one of the most valuable things you can own. 6. They use debt as a tool, not a trap. For most people, debt is a dirty word. It's credit cards, car payments. They see it as things that drain your bank account. The rich see debt completely differently. They see it as leverage. They know there's good debt and bad debt. Bad debt is borrowing money for stuff that loses value, like a fancy car or a lifestyle you can't truly afford. Good debt is borrowing money at a low interest rate to buy assets that will grow in value or produce income at a higher rate. The wealthy are masters of this. They borrow against their stock portfolios to get cash for new deals without having to sell their existing assets. This lets their money stay invested and compounding, while they use the bank's money to get even richer. The lesson here is to change your mindset. Avoid high-interest consumer debt, like the plague. But don't be scared to use smart, low-interest debt to invest in things that can grow your wealth, like a rental property or even your own education. 7. They invest heavily in themselves and their teams. The single greatest asset you have is your own ability to make money. The rich know this, and they invest relentlessly in themselves. That means education, coaching, learning new skills, and building a powerful network. But they don't stop there. They build an expert team around them. They don't try to be an expert in everything. They hire the best tax strategists, lawyers, and investment managers. They know that paying a top-tier professional isn't an expense. It's an investment that can pay for itself many times over through better deals and costly mistakes avoided. You can start applying this right away by prioritizing your own learning. Buy the book, take the course, go to the seminar, and as you grow, don't be afraid to build your own team. A great accountant or financial planner can be one of the best investments you ever make. 8. Their time horizon is generations, not quarters. In a world obsessed with short-term gains and quarterly earnings, the rich are playing a much longer game. Their focus isn't on making a quick buck. It's on building wealth that lasts for generations. They are patient. They hold assets for decades and let the magic of compounding do the heavy lifting. This long-term view allows them to ride out market turbulence without panicking. When markets drop, they don't see a crisis. They see a sale. This patience is a superpower. It means focusing on quality assets that will grow for years, not just chasing quick wins. This is probably the easiest principle on the list to understand, but the hardest one to actually do. It takes real discipline. You have to resist the urge to constantly check your portfolio or jump on the latest hot stock. Think in decades, not days. 9. They optimize for taxes above all else. All right, this is the big one. The rich don't just accept taxes as a fact of life. They view the tax code as a rule book created by the government that's filled with incentives. Their goal isn't tax evasion, which is illegal. It's strategic tax avoidance by using every legal tool and loophole to pay as little as possible. How? They structure their businesses and investments in the most tax-efficient way. They use special trusts and LLCs to protect assets and pass them on. They invest in things that come with tax breaks, like certain municipal bonds or real estate with its depreciation benefit. They hold on to appreciating assets for as long as possible to avoid capital gains taxes. And if they need cash, they often borrow against those assets instead of selling. Crucially, they work with tax strategists, not just tax preparers, to plan ahead. The lesson for you is to start taking tax planning seriously. Max out your tax advantage accounts like a 401k or an IRA. As your situation gets more complex, look for more advanced strategies. The goal is simple. Legally keep more of your own money so it can keep working for you. 10. They bet on the future with technology and innovation. Finally, even though the wealthy are patient, long-term investors, they aren't stuck in the past. They are always looking forward, investing in the technologies that will shape our future. This means putting money into venture capital funds that back groundbreaking startups in fields like AI, biotech, and green energy. For instance, spending on AI is expected to grow at an insane rate over the next 5 years. The rich want a piece of that growth. They might also have a small, speculative allocation to digital assets like crypto, not as a lottery ticket, but as a tiny part of a highly diversified portfolio. They use data and AI-driven tools to manage their wealth and spot the next big thing. For you, this means making sure your own portfolio has some exposure to innovation. This could be a tech-focused ETF or making small, calculated bets on emerging technologies you truly believe in. The point is to position a part of your wealth to catch the explosive growth that comes from world-changing ideas. So what's the real secret here? What ties all of this together? It's a complete mindset shift. The rich don't just work for their money. They make their money, their assets, their debt, and even the tax code work for them. They think like owners, not employees. They focus on buying cash-flowing assets, using other people's money to their advantage, and always planning for the long haul. This isn't about being born rich. It's about getting your hands on the right playbook. Even starting with one or two of these ideas can radically change your financial future. So, I've got a question for you. Which of these 10 strategies was the most surprising, or which one are you most interested in learning more about? Drop it in the comments below. I'll read every single one. And if you want to explore more strategies that separate the wealthy from everyone else, make sure you subscribe and turn on notifications so you don't miss what's next. You don't have to be a billionaire to start investing like one. It all starts with changing your mindset and your strategy. Start small, be patient, look beyond the obvious, and never stop learning. That's how you stop playing their game and start building a legacy of your own.